At the start of a new year, I think it is appropriate that we just review what has happened in the previous year and compare that with our expectations that we set out at the beginning of last year. From an economic growth perspective, the world continued 0.5% for 2019. No surprises there. During the year, the market had to grapple with the two well-known possible risk factors. The one, of course, is the trade negotiations between the US and China, and the other one was the whole issue surrounding Brexit. Towards the end of the year, we had resolution on both of these issues. The phase one trade negotiations trade deal was signed by both the Americans and the Chinese. And the 12th of December, the British population decided that Brexit will go ahead. Despite the outcome of these things, the fact that the market didn't like the Brexit issue, it brought certainty to the markets. And in the fourth quarter last year, we saw growth assets performing extremely strongly. And I would say that if you look at the performance of financial markets, the major surprise last year was the very strong performance of global equities. The MSCI index recorded a total return of just over 28%, largely driven by exceptionally strong performance from US equities that gained 31% last year. As you know, we were rather cautious about the equity market because we thought that the market was quite elevated. However, half-decent earnings growth, but a massive improvement in sentiment drove the equity market, and our clients got the benefit of the very good performance. Bonds didn't do particularly well, and as we argued, bond prices were very high at the beginning of the year. They've remained high, but they have underperformed during the year. If we turn the focus to South Africa, it was another very tough year as we expected. South Africa had to struggle through the issues with state-owned companies, with the biggest issue, of course, Eskom, and the power cuts that the economy had to deal with. The net result was an extremely pedestrian growth rate, with massive concerns by investors around the macroeconomic health of South Africa. Growth assets in South Africa disappointed. Although the all-share index gave a total return of just over 12%, if we exclude mining shares, the rest of the market only returned 4.5%, which was a return lower than the 7% that cash offered us. The other massive issue that we had to deal with in the equity space was that there was extreme disparity between the performance of the best performing shares, which by the way was Impala Platinum, that gained more than 200% during the year, and the worst performing shares, which was Into, that lost about 70% of its value. This very wide range created scope for fund managers to step into potholes that might have eroded investment returns for clients. So that was 2019 in a nutshell. More often than not, people think that if the calendar year changes, that you must have a different view of the world and of course of the performance of different financial markets. In our case, the fact that we moved from December to January didn't really change our macro view. We still think that global growth will be in the area of about 3%, 3.5%. But I think the one issue that the market will certainly focus on is how the growth momentum in China is going to slow down. China recorded a growth rate of 6% last year, which was the lowest in 3 decades. The risk is that that growth rate slows down, and that, of course, as we know, is the second biggest economy in the world, with big demand for commodities and a specific impact then on commodity producing countries like South Africa. The other focus, of course, will be if you see disappointments in economic growth, how economic authorities will respond to it. The one factor that we certainly picked up over the last few years is that whenever economic authorities globally, in the US, in China, in Europe, when they do perceive that economic growth rate is slowing and that there is danger for recession and that price changes are quite pedestrian, the authorities are quite prepared to step in with supporting actions. If that remains the case, I don't think we need to be too concerned about a recession this year and simply a slowdown in momentum, given the fact that we've already had a 10-year of uninterrupted economic growth in most of the important economies in the world. So I think that will be business as usual. What does it mean for global financial markets? Well, we've got to look at the prices. And again, the bond prices are really uninspiring. So we don't think that global bonds, particularly in the first world, of course, will give you a massive return. However, as we know, global bonds and particularly American bonds have always been a good buffer should a crisis evolve in financial markets. So it's not an asset class that one can completely ignore, but I think one would be naive to expect that that particular asset class will give you above average long-term performance. That brings us to the equity market. Of course, that was a star performer last year, and as I said, the US market in particular performed well. However, if you analyze the performance of the US market last year, the more than 30% performance of the US equity market, only 2% of the 30% was derived from better earnings growth. The other 28% came as a result of a re-rating or positive change in sentiment. We think it will be unrealistic to expect a similar driver, in other words, a rating change in the performance of global equities, and particularly US and European equities this year. So we downscale our expectations in terms of performance from global equities to between 5 and 7% in dollar terms, which still beats inflation, but a quantum step lower than the 28 or 30% that we saw in the US last year. That brings us to South Africa. I think the problems of South Africa is well documented. We don't see a major change from last year's very pedestrian performance. The struggling SOEs, the fiscal problems, and of course with that, the lack of confidence, and specifically confidence in terms of investment, will put a lid on economic growth in South Africa. Within this macro environment, it is very hard to expect that companies that make the bulk of their profits in South Africa, they will surprise on the upside in terms of earnings or profit growth. And that, of course, brings the whole issue of the prospective returns into question. Why would one then invest in South African equities? And I think for us, the answer lies in one word, and that is price. The price or the valuation of South African equities is now, for the first time in about 5 years, really cheap. In other words, what we're simply arguing is that the negative view held by many investors about South Africa's macro environment that spills over into the environment where companies do business, that is now, to our mind, priced in. So should we get a slightly better outcome than what the market expect, we think that South African equities might surprise on the upside in this particular cycle. In short, if we want to put a number to it, we think that South African equity market can achieve double-digit returns for investors who are brave enough to stay the course on this particular asset class. When we look at fixed interest assets in South Africa, the yields are still pretty attractive. When you invest in a 10-year government bond, the yield is just over 8%, which is significantly higher than that of the inflation rate. However, we spoke about the fiscal issues. That, I think, will keep some of the investors on the sideline. So therefore, an 8% or 8% plus return is likely, but that is associated with a fair dose of risk, given the fiscal issues that we have to deal with in South Africa. There are many local listed property companies that are now trading at a dividend yield of more than 9%, a yield that actually takes us back to levels that we've seen last in the late 1990s. However, there's no doubt that the oversupply in the property market that we've seen developed over the last 10 to 15 years, it is now coming to haunt the property market. So we will be very hesitant to take an aggressive approach in this market. We think that the oversupply should be diluted over time, and once that happens, we will be more aggressive in this market. I think it will be another year with a lot of challenges, but it's certainly not a year where we think that investors will not be rewarded for the risk that they take if they buy risky assets like global equities, like South African equities, but you've got to stay the course. Volatility, like we've seen last year, remains part of the investment landscape in South Africa. We can't escape that. But we do know that the longer-term approach will ultimately reward investors.